Hey everyone, welcome back to Corporate Decoder, the place where we dig deep into those confusing corporate filings. Today we're cracking open NKGen Biotech's latest quarterly report, and let me tell you, it's a bit of a roller coaster. Get ready for some financial acrobatics, because this company's trying to pull off some serious moves, and whether they stick the landing is anyone's guess. NKGen Biotech, if you don't know, is trying to make waves in cancer and Alzheimer's treatment, betting big on something called natural killer cell therapies. But the question is, can their science translate into dollars and cents? Right off the bat, they give us the usual disclaimer about forward-looking statements, reminding everyone that the future is uncertain and their actual results might be totally different from what they're hoping for. It's a standard practice, but also a little ominous, like they're bracing us for bad news. Let's dive into the numbers, and yeah, they are pretty rough. Their cash position is scary, sitting at just $8,000. I know that sounds like a typo, but it isn't. At the same time, they have current liabilities that are huge at over $37 million. That's the kind of imbalance that makes accountants sweat. It raises what's known as substantial doubt about whether they can continue as a going concern. In plain terms, it means there's a real risk they might not be able to stay in business for the next year. To give you the full picture, their accumulated deficit, all the losses they've piled up over time, is now a whopping $177 million. They are bleeding money. Their income statement doesn't offer much relief either. Their research and development costs are still high at almost $3 million for the last 3 months, showing they are pushing forward in the lab. The good news is that is less than the same period last year, but the money going out is still considerable. However, while the overall operations saw a loss, a financial maneuver made them turn a profit of $6.5 million, which sounds good but really isn't. They were able to book this profit from changes in the fair value of financial instruments. Those are complex accounting calculations that have little to do with the actual running of the core business. Here, management admits they've been burning through cash and will likely need to tap into additional funding to keep the lights on and those labs running. That means more stock offerings, more debt, or striking deals. They used almost $14 million in operating activities, so where does that cash even come from? They've been kept afloat from issuing convertible promissory notes, which is essentially borrowing money that can be converted into stock later. They've received millions from this. The constant need for funding makes it harder to properly conduct day-to-day operations. It talks about the business combination and all the stock shuffling that came with it. Basically, they issued a ton of shares to make the deal happen. It's complicated, but it is the root of some major accounting changes. And speaking of complex deals, let's look at their private placement agreements, also known as FPA. These are deals where they sold stock privately to investors with some interesting strings attached. There's a whole section dedicated to amendments and settlements within these agreements. The report also addresses the accounting practices for when it doesn't have the authority to issue shares. The company details the sequencing policy based upon issuance dates to solve the problem that at times, it has issued so many financial commitments that it might not have enough authorized shares to actually fulfill them. This is not a good sign. The company has a lot of warrants, which give the holder the right to purchase shares of the company. As of September of last year, they had 21 million shares with another 41 million shares through complicated financial products. They're also leaning heavily on related party transactions, specifically senior convertible notes from NKMAX. That raises eyebrows because it means they're relying on insiders to keep them afloat, and those deals often come with strings attached. They've had to make changes in how they calculate the fair value of some of these financial instruments due to changes to how the business was operating. Basically, this all boils down to NKGen admitting there's substantial doubt they can continue as a going concern. They need more cash, and they need it fast. There are no legal proceedings happening right now, but a former employee made a demand for wrongful termination, so that's another thing they have to deal with. Now, what does all this mean? It points to a company stretched thin. They're burning cash, relying on complex financial maneuvers, and facing a whole lot of uncertainty about the future. They are still years away from selling any actual products, and that is a huge problem when you're bleeding money. Also, they have a loan agreement with the East-West Bank, but they may not meet all the requirements. Any failure to maintain compliance would not only result in default under the EWB loan and the security agreement, but it will severely diminish our near-term operating flexibility. And then there's the NKMAX acquisition, which is their planned merger with NKMAX. Whether or not they can pull that off is a giant question mark, and that acquisition approval requires a lot to go right. They were selected as the preferred bidder for the acquisition of NKMAX. This whole situation is really a bet on future results, but right now, the numbers don't lie and the path ahead is hard. They are clearly struggling. This company is under a lot of pressure. It needs a major win soon to turn the ship around. For now, it's a high-risk situation, and that's the scoop for today's corporate decoder. What do you make of NKGen's situation? Do you think they can pull off a turnaround? Let me know in the comments below. And of course, don't forget to like, subscribe, and hit that notification bell so you never miss an episode. Thanks for watching.